Welcome to the System Simplified podcast, where we feature top leaders who share stories on how to successfully systemize a business. Now, let's get started with the show.
Hello, Adi Klevit here with the System Simplified podcast, where we interview top founders, entrepreneurs, and thought leaders about systematizing a business. And this podcast is being brought to you by Business Success Consulting Group. At Business Success Consulting Group, we create custom processes and tailor-made business systems so businesses can grow and thrive. And today's guest is Charles Warren. Hi, Charles.
Good morning, Adi.
Good morning. And Charles is one of the partners and plan consultants at Pacific Retirement Partners. And Charles has over 25 years of experience in this field, in the retirement planning field, retirement plans. And Charles is a good friend, and I've got to know him over the period of time we've been working together with partnership, working with clients. And Charles really knows businesses. He really understands what businesses need. And that's why, Charles, I'm really excited for you to be here today, because we're going to talk about systems and how they apply to actually having a good benefit or retirement plan for the employees, and how we can actually systematize it or being more in control over. And we're going to cover different aspects that business owners usually ask or they're curious about in terms of having having retirement plans in place for themselves and for their employees. And you're going to share your knowledge. So I'm really excited about that. So first of all, in terms of the introduction, anything else that you would like to tell the listeners about yourself?
Well, Dee, I appreciate you inviting me here this morning, and super excited. I'm kind of a 401k geek, so being able to talk about retirement plans and how they can run more effectively is definitely something that I'm passionate about. I'm a Pacific Northwest native. Grew up in Oregon, spent most of my life here. Went away for a period of time when I was serving in the Marine Corps for about 10 years, but came back with my wife and my family, and we live in the Gresham area, and absolutely love being here and spending time with our family. So very excited to be able to share with you this morning, and hopefully it'll be of benefit.
Excellent. Okay, good. So let's start. Let's talk about the number one. I think one of the number one we talked about before the podcast, and we were looking at different, like what do business owners ask you? And one of the things that they ask is, how can they make sure that they're actually meeting the fiduciary duties that they need to when having a retirement plan?
Adi, great question. And I think to back up just for a quick second, it's important first for business owners to understand that they do have fiduciary duties. I think most businesses today understand that. It's been much more prevalent in the media and just in conversation in general, different association groups. I think most business owners who make a company retirement plan available to their employees, especially a plan that falls under ERISA, they understand they have fiduciary duties. And, I liked discussing this because considering what you do and your expertise is right in your wheelhouse, we tell clients and prospective clients when we're visiting with them, having a repeatable, documented process is the number one key thing you can do to make sure that you're fulfilling your fiduciary duties. It's kind of common sense. Once you know what your duties are, have a checklist, have something that's repeatable, that's documented, so you're just not missing anything from year to year. It can be as simple as that. And there's no right or wrong as to how that process looks. Obviously, some are more efficient, right, than others. But I would say the key thing is make sure it's repeatable so that you're not forgetting things, and make sure you're documenting, because if your plan's ever audited, that's going to be a big deal. Not what you say you've done, but what you can show you've done.
Absolutely. And that's where documentation is the key. So, if a business owner is asking themselves, how can they best measure the quality of the investment that they're offering their the options in the retirement plan? So how can they measure that?
Adi, it's interesting. I think kind of perpetuated by my industry. The investment options that a plan makes available to their employees is probably where people tend to fixate, both on the advisory side as well as on the plan sponsor or the company side. And while we certainly understand the importance of having high quality investments, and there's definitely specific requirements under ERISA that the Department of Labor looks at as it pertains to investment options, We often tell people, look, the investments, while important, they're not the biggest key, but specific to your question, the biggest thing that we encourage clients to consider is, first of all, having what's called an investment policy statement. ERISA requires that a plan fiduciary demonstrate what's called a prudent investment process. Okay, that's from ERISA. So what is that? Having an investment policy statement, it's not a contract, it's a written document that helps to outline the specificity of how you're demonstrating a prudent investment process. So you have an investment policy statement. It talks about how you select investments, how you're going to monitor investments, how and when you should replace investments, the duties of all the people pertaining to servicing the plan, who's doing what. So that's kind of spelled out in writing. Here's how we're making investment decisions. Here's the process that we're following. And then following on from having an IPS, as we call it, an investment policy statement, most importantly, is you have to have a good documented process to show that you're adhering to your investment policy statement. So it's one thing to have a written prudent investment process, but if you're not following it, they're not going to look favorably on that. So those two things hand in glove: have a good written process and then document that you're adhering to the process.
That's great advice. And then let's say, when I work with businesses, we also write their financial processes, and part of it, they want to review their expenses, and they want to make sure that what they're paying is in par with what the similar businesses are paying for a plan like the ones that they have. How can they make sure that the costs are actually in alignment with what they should be paying?
Fantastic question, and it impacts on several levels. One, there's a requirement under ERISA and some fee disclosure legislation that was passed back in 2012 called the 408B2 legislation, the 404A5 legislation, or regulation, I should say. And part of the requirements under ERISA, one of the fiduciary duties is ensuring that you're incurring no more than reasonable cost for the quality and scope of services that your plan is receiving. So this is where it gets a little ambiguous, right? Because oftentimes business owners don't know how to measure the quality of the services they're receiving. It's like, well, my advisor does this or that or the other for me, but I don't really know how that stacks up. Sometimes, sadly, they don't even know exactly what the advisor is in fact doing for them. So that speaks more to the scope of services. Perhaps they don't have a formal written engagement or consulting agreement with their advisor. So nothing is really spelled out. It's, the advisor may go in and, do the sales process of acquiring them as a client, say, well, we're going to do this, that, and the other for you, but there's nothing in writing. And so, the owner says, sounds good, they move forward. But then it gets really murky as to whether, what the advisor promised on the front end is actually being fulfilled on a consistent basis. So I mentioned that part because, you can look at the quantitative data. So there's services that we provide to clients called a fee benchmark analysis that will go out and pull public information of similar plans to the plan that we're evaluating. So that could be the amount of assets in the plan, the number of participants, those types of things, perhaps depending on the database, maybe even the industry that they're in. And we can compare and contrast the plan's current costs versus, the averages for whatever plan information are in those databases. And so that's helpful on a quantitative perspective to say, okay, well, based on the size of your plan, the number of participants, you're in the ballpark. But then we get into the aforementioned scope and quality of services. So it's not always a true apples to apples. Somebody could look like they're paying or getting a good deal, and yet they're getting no service. So is that really a good deal? So we think it's important to marry the quantitative data, the numbers, if you will, with some good qualitative questions so that we better understand, is a client really in a good position, or should there be some negotiation going on to reduce costs?
Absolutely. Well, that brings me to my next question, which is, what should we expect from our relationship, or the qualities that we should expect from a financial advisor that we work with regarding a plan?
I'll sum it up in one word, and that's partnership. in our opinion, it's not by accident that the name of our company is Pacific Retirement Partners. That doesn't allude to myself and our other partner as much as it does to the concept of partnership with our clients. And the plan sponsor, the owner of the company, the decision makers, we call the plan fiduciaries. So that could be the actual owner of the company or somebody he delegates this responsibility to, maybe a CFO or a senior manager, something along those lines. Partnering with them to ensure that we're helping them fulfill their fiduciary duties and that we're documenting that. That's critical. But also partnering with the employees. We often say if you look at the letter of the law of ERISA, that's one thing, but the spirit of ERISA is what we tend to look through to as well, because we believe that when ERISA was passed back in 1974. The spirit of that was to ensure that, employees who were offered a retirement plan, those plans were run correctly. They were run for the best interests of the plan participants or the employees, and that employees could save for their retirement in a meaningful way. So if a good advisory relationship for us has a foundation of partnership, making sure that we're doing those two things, maximizing fiduciary protection for the plan fiduciaries and optimizing the retirement readiness for all the plan participants, which often can include the owner, right? If they're participating in their own plan, and hopefully they are. So it's all plan participants and those participants' beneficiaries.
Absolutely. So, those are really good. You gave us great advice. You walk us through the process and what needs to be documented. And, I really believe that every process, in order to be or when a process is successful, we know it's successful because we measure it. So there is a correlation between measuring a process that you have and the scorecard or the measurables, KPIs, metrics, whatever you want to call them, because that really will be an indicator that if you follow all the best practices as they are laid out in a process, you actually know that you achieve success. So,
100%.
Right. So with a plan, with a retirement plan, from your experience, what will be some of those measurables? How can we measure success that the plan is working for you as the employer? And of course, as you said, hopefully they're also the participant as the employer, but also for the plan participants, and really making sure that you are taking care of your employees, of yourself. How would you measure success?
Adi, that's an amazing question, but it requires some unpacking because there's a lot of stuff here. If you think about all the things we've discussed already, if you can picture visually kind of a funnel, the open end of the funnel, we're throwing all these topics in there, the quality of the investments, the cost of the plan, fulfilling fiduciary duty. But it goes back to what I said earlier about this kind of the spirit behind ERISA. If you think about it from this perspective, you could have the best run plan from a plan governance perspective, meaning you could be doing all your fiduciary duties. You could have a good documented process. You could be adhering to all of your processes that you put in writing. You can have top-notch investment options available for your employees. You could have super competitive, efficient pricing for your plan. You could be doing all these things really, really well. And yet the reality is, if people aren't saving enough into the retirement plan, right, then it's a little bit of a moot point. We tell people, listen, the single largest driver of success as it pertains to retirement saving outcome is your savings rate, what the industry calls deferral rate. So, you're an employee at a plan, Adi, and, the employer says, hey, we'll match up to 3% of your contributions, your deferrals. And you say, well, I'll defer 3%. So I get that full match. And we tell people, yeah, that makes all the sense in the world. That's why leave free money on the table, right? The company's money. You definitely want to take advantage of that. So you add your 3% deferral with a 3% company match and you're at 6%. And most people say, well, I'm doing great. And yet statistically, the data shows that people ought to be saving somewhere between 10 and 15% of their annual compensation. They ought to be saving into their retirement plan or for retirement, whether they do it in the retirement plan or they stick it in the bank or they put it in another investment account, but they should be saving 10 to 15%. And the reason for that is kind of twofold. One, if you think about it, what they call defined benefit plans or pension plans are pretty much gone today. I mean, if you don't work for a governmental agency, whether it's a city, county, state, federal government, or a union, there's not a lot of pensions out there. there's a lot of defined contribution 401k plans. The one constant that has moved from the defined benefit world to the defined contribution world is Social Security. And yet Social Security was never designed to be the sole source of retirement income. It only covers about a third, okay, of what somebody was making prior to retirement. Coupled with longevity, right? People just live a lot longer in retirement nowadays. It's not like the old days where the average, duration of retirement lifespan was about 9 years. Now people could live 20, 25 or longer or more years in retirement. So if you think about retiring, having a potential lifespan post-retirement of 20 or plus years, Social Security covering about a third, where's the other 2/3 going to come from? Well, it's going to come from what you've put away for yourself. So a little bit of a long answer, but the way that we measure retirement plan success is what we call income replacement. So how on track are all plan participants moving towards replacing whatever percentage of their pre-retirement income they desire to replace? Some people are saying, well, if I could retire and have, 50% of what I was making before I worked, I would be fine. Other people are saying, well, I need 70 or 80%. So it's a kind of an individualized gauge as far as success. But what we tend to fixate on as an advisory firm is, hey, let's do what we call using a poker term. Let's make sure we're doing all the table stake stuff well. Good investments, good fiduciary process, keep the costs down so that we're not dragging on participants' accumulation. Do all that stuff really, really well. But then let's make sure that we educate and advise all the plan participants of what they need to do personally to be able to be successful with their retirement. When we can gel those two partnership areas of focus together, again, it goes back to partnering with the owner, partnering with the plan participants. When we do that really, really well, we've seen pretty great success from the retirement plans that we serve.
That's fantastic. Great advice. And you really walked us very well through your process, through how a business owner should be thinking when thinking about retirement, and also gave us amazing points in terms of what measures success, what success looks like, what are the best practices, and how to make sure that you actually have a process in place that you can follow in order to know that you are actually meeting your fiduciary duties, which, as you made very clear, that we do have those as employers, and making sure that there is a process so you can just follow the process and make sure that the plan is working. So that was great conversation about how we can actually take the subject of retirement plan and make it into a process. So was very enlightening. So thank you so much, Charles. And if our listeners would like to contact you, what's the best way to contact you?
Probably via email, Adi. It's just my first name, Charles, and it's at PACRP. That stands for Pacific Retirement Partners, PACRP.com. Email is probably the best way initially to reach out, and I'd be happy to be a source of information, answer questions, or just be available as a resource, because it can be confusing. Obviously, that's why I do it full time, right? Because business owners don't have time to do this function full time. So be happy to help anybody that maybe has some questions or would like to get some advice.
Fantastic. Thank you very much.
Adi, thank you so much for having me. Have a great day.
You too.
Thank you.
All right. Great. You did fantastic, Charles.
Thanks for listening to the System Simplified podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.